Halloween is only a few days away, but many investors have already been spooked by this market this week. The question we answer today is how scary will the next 3 to 6 months look? With the cornerstone of this market entering correction territory and investor sentiment slowly tanking, it's time we bring out the stats to answer the question on everybody's mind. Are we on the verge of the worst case scenario where a deep correction in technology stocks becomes a reality, taking the whole market down with it? Hello ladies and gentlemen, welcome to the daily recap show where we talk about stocks and the financial markets. We have a lot to unpack today, so sit back, enjoy the show. If you like this video, please subscribe, hit the notification bell. Let's get into it. And you would think with how the day panned out today that every single sector in the market was red, but no, the market leaders, technology, semiconductors, communication services, these were the stocks that really sold off, with the rest of the market holding up fairly well, especially right here, real estate, materials and utilities performing the best in the market today. Again, materials, utilities and real estate really were performing the best, with real estate up over 2% on the day. However, all sectors were down and we did see red days all in all, mostly in part due to communication services and technology. They were really the leaders on the way down. Having a look at commodities, oil continues to slide, as well as gold and silver just not really doing anything significant after last week's major run. But for the moment, it seems that energy is going down and precious metals is just range bound. Looking at the treasury market, the entire curve went lower, which is very weird considering the fact that stocks also went lower, but the entire curve went lower, yields fell, and that means bond prices went up. TLT, the long bond, was up 1.53% for the day and actually up about 2.5% for the week. So we have seen an increase in bond prices and a decrease in yields. So this should bode well for the stock market, but once we start selling, the algos kick in, big money kicks in, dumb money kicks in, and we have sort of this capitulation happen. Now, we did get some, I guess you could say, good data or bad data. Good news is bad news. GDP grew at 4.9% annually in the third quarter, which was actually better than expected. Gross domestic product, a measure of all goods and services produced in the US, rose 4.9% ahead of the 4.7% estimate. So it was actually some hot GDP data. The sharp increase came due to contributions of consumer spending, increased inventories, exports, residential investments, and government spending. And this government spending was the big one. While the report could give the Fed some impetus to keep policy tight, traders were still pricing in no chance of a rate hike when the central bank meets next week. So highly unlikely we see a rate hike next week, but anything could happen. Don't take the word of CNBC, just take the word of the Fed. So we've had a major week of earnings, and today we had Amazon and Intel. Intel produced great earnings, but let's dig a bit deeper into Amazon's earnings. Amazon beat on earnings per share and revenue, and they grew everything from net sales, North America and international. AWS came in a little softer than expected, however still 12% growth year over year, as well as EPS, net income and operating income all grew significantly. Look at these numbers, guys, just wild. So huge operational efficiency on the back of 2023 when compared to last year. That being said, the stock did get sold on the day, down 0.5%, but if we actually dig a bit deeper into what happened after hours, we can see here that the stock did this all day, and then after hours on the earnings it shot up nearly 7% on the day. And in a market that wasn't this red and there wasn't so much sell side, I think Amazon is up like 15% on the day. It did come down, algos bought it here, but it's sort of finished around this area, 2% up for the day in after hours trading, and it's probably going to go higher. It's probably going to go higher tomorrow if the market does see some form of a relief rally, because Amazon's earnings were very good, and tech as a whole was actually tech as a whole has been good. I thought Google's earnings were good. I thought Meta's earnings were good. That being said, is technology a buy? I would say yes. We're expecting double-digit growth for the next 3 quarters up until Q2 2024. But where should you invest in technology? Communications equipment and software. They're expecting 17 and 16% growth respectively. IT services is expecting 5%. Try and avoid hardware, semiconductors and electronic equipment unless you can get them at good prices and good value. And with the sell down, I would start building a watch list, especially companies in software and comms equipment. Now, is the market as a whole a buy? In my opinion, long term, yes. We are sitting at about a 17.3 to 17.7 PE depending on what you look at, and we are sort of sitting at the 10-year forward average for the S&P 500. So where is investor sentiment sitting? Have a look here. Right now, as the survey was taken a couple days ago, 43% of people are bearish compared to last week when about 34% were bearish. It was fairly dispersed between bullish and bearish members. It's so crazy how in just a couple of weeks, everything can change from 40% bullish to 43% bearish. And we had another big day with unusual options activity. We can see here, we did have some very weird trades. Look at this. ProShares Ultra QQQ. This is the 3x Bull ETF, 36 million calls against 23 million puts right there. We also had the usual suspects, Alphabet, Netflix, just all of technology, because they were the leaders in the sell-off that happened today and in the last 2 days. And then we also did have, just the standard culprits, QQQ, IWM, more on the put side, and it's to be expected with the sell-off, as well as TLT right here. Fairly equal on the calls and put side in terms of notional value. Huge amounts of volume too. We saw $44 million in total options contracts. But that being said, 52% calls, 48% puts on very, very stellar volume. Could the market bottom be, could people be buying the bottom? Potentially. It's yet to be seen. I'll keep you guys updated. Investor sentiment is one thing, but what is smart money doing? And that's something that we always want to look at. And this is the smart money, dumb money confidence. And we can actually see here that even though the market has sold from its highs, about 9.6% in the S&P 500, dumb money has actually been selling, which is no surprise. Dumb money tends to sell when the market goes down, but smart money, they've seen a little bit of selling. All in all, they have actually been holding quite steadfast, which is really great. Now, this could get really bad if smart money starts selling. We could see further capitulation, but I think that if smart money were to sell, they probably would have already, and they have a tiny bit. They probably have trimmed their holdings a little bit. But that being said, dumb money is selling and smart money is holding the line. This is some more stats I got for you here, and we're going to look at some positive breadth divergences. We saw that tech got sold, but most of the other parts of the market were green, especially parts of the market that was sold off this year. And this is strong leadership versus weak leadership. We've had very strong leadership in technology, and what this core leadership model here is telling us, leadership is now actually at an all-time low. In other words, the reflation trade is happening. And essentially what the reflation trade is that certain sectors other than the leaders will perform better immediately after a recession. Based on the GDP numbers, we could say that we probably have averted a recession, and we're going to see some rotation into stuff like materials, utilities, real estate, financials, stocks that have been really beaten down this year. We're probably going to see a rotation into that. So it's probably good to start allocating capital towards those sectors. This is the percentage of stocks above the 20 DMA and the 50 daily moving average. I pointed this out yesterday that we are seeing higher lows. Despite the market moving lower, we're actually seeing higher lows in stocks. So stocks are reclaiming their 20-day and their 50-day relative to the lows put in last week or the week before. Again, very similar indicator. The McKellen oscillator measures the very same thing, just with a different type of velocity, higher lows. This is advance and decline ratios. On a day that was as red as today was across the market, you would say that the entire market was declining. But that was not the case. We know that's not the case. Look here, Russell 1000. There were more advances than decliners. Look at the same thing here in the Russell 2000, even more. Russell 3000, same thing. Look at the New York Stock Exchange Composite, 1.3% of stocks actually advanced. And then you look at the S&P 500 and NASDAQ Composite, more stocks declined, but only marginally. You would think, again, on a day that's as red as today, you'd see like a 0.25 print for this and this was all of these. No, we're actually seeing, more stocks advancing, and that's why they're retaking their 20-day and their 50 daily moving averages. Let's actually have a look at the decline. So we have declined. The S&P 500 has declined 9.6% from the highs in June up until right now. So it's a 9.6% decline, nearly 10%. So this is the anatomy of the S&P 500 index decline. So this is in a single year. So this is a dip, 5% or more from highs to low, last occurred on the 31st of July. That's when we dipped more than 5%. The number of occurrences that this happens a year is 3.4. Now let's have a look at a correction of 10% or more. Last time a 10% correction or more happened was on the 16th August 2022. So last year, near the lows. The number of occurrences since 1928, okay, is 1.1. So this is the first 10% correction we've seen this year. This is completely normal. It's 100% normal to see a 10% decline or more. And there's a 46% chance we actually see a 15% decline. There could be more selling on the way, guys. Just understand that this is completely normal, and this happens once every 2 years or 0.5 times every single year. So once every 2 years, we will see a 15% correction or more. More stats. I'm going to bring out more stats. This is the S&P 500 large number of down days. In 2023, we've had 26 1% days or more decline, and we've only had 2% decline or more on the S&P 500. This is completely normal. If you actually have a look right here, we're still well within the ranges. In 2022, we had 4. In 2021, we had 16. In 2020, we had 20. Look at stuff like 1928 to 1940. Huge. I know this was a very bearish period, but still, the amount of times that we're having 1% down days in the S&P 500 relative to just the historical average, we're well within the historical mean. This sell-off, even though you look at Twitter and everybody's bearish, we're still well within seasonality. We're still well within the data. We're still tracking along as if it's a normal market year. Now, there are outliers. I get it. Rates, geopolitical tensions. I understand that. But what I'm trying to say is that if we just look look at the stats as a whole, remove your emotional bias, the market is still moving the way the market does. The market is moving the way the market always has. Let's break down the stats some more. S&P 500 index, max intra-year drawdowns and the end of year total returns. One thing I want to point out is that the average drawdown right here is actually 13.1%. So the average year has seen a drawdown of about 13%. Right now, we're at 9.6 on the S&P 500. So there could be more selling to go. And remember what I said, 46% chance we go to a 15% decline. All things considered, when you look at the maximum drawdown that we have and then the market returns, generally speaking, even when we've had significant drawdowns, especially since 1970, we've always had positive years. Again, 13% average drawdown since 1928. We're right now at 9.6 on the S&P 500. So expect a bit more selling. Maybe we get a pop on Friday. Have some money ready, have a stock list ready, and buy when people are fearful. Okay, be greedy when people are fearful. Let's actually have a look at seasonality, and I pointed this out yesterday. This is 2023. This is normal year seasonality, and this right here, pre-election year. And you can see that we are actually following the pre-election year seasonality. Now, we sort of have just this very trepid action right here. Then we do see a bit of a sell-off from about the middle of October, and we sort of mark the low around this area right here, where we are right now. With everything we've seen both in the positive breadth divergences and all the stats I just showed you, we're well within market seasonality, and we're sort of trying to find a low right now. And now let's keep going into seasonality. This is the S&P 500 pre-election year aggregate cycles. And again, you can see this is what we normally follow. We've had a huge run up. We've come back down over 10% or just under 10%. And we're again, we're going to try and find a bottom in this area here to look for an end of year run. And the exact same thing with the NASDAQ. In fact, the NASDAQ is tracking ahead of everything. Okay, the NASDAQ pre-election year, we're trying to find a bottom in this area right here. Now we could go lower, we could find a bottom right now, but what you have to do is sometimes take the risk, buy, sit on your money, buy some more, sit on your losses, buy some more, because I do believe, according to seasonality, Q4 run is still incoming, and I am a buyer of technology. I am a buyer of small cap quality. I am a buyer of undervalued high moat companies. Where do we find a bottom? The Q4 rally to commence if the S&P 500 manages to stay above this zone right here, 4150 to 425 by 11th of the second. This is the zone. This is where the market is right now. So we are literally exactly in this zone. If we go below here, I'm going to have to reassess everything. But as long as we stay in this zone, seasonality is going to take hold. Now we could sell, which again, I will keep you guys updated. But as it stands right now, we're trying to find a low in this area, and I am a buyer of technology. Let's go into some dark pool trades now. So there was some very, very interesting stuff right here. The S&P 500, the SPY, huge trades came in here. Nothing up here, a small little trade right here, but we just saw huge amounts of buyers in this area right here. And this is the 5 largest trades, and they were all here right at the lows. Breaking down the equal weight, what we also saw at the lows right here is the second largest trade of the year. But look at what we saw here. The biggest trade of the year, the third biggest trade of the year, which was then closed off by the second biggest trade of the year. So these shorts could have been closed, and there could have been buyers entering here as well. Having a look at the Qs, huge trade right here. Now something to note is that when trades occur well above the spot price, okay, normally price tends to gravitate toward these, at least according to the documentation on volume leaders. We did see another trade come in here, and then we did see like a intraday spike. However, could it be a short? Could it be a long? We don't really know, but we do know that price went lower, and then we saw another big trade come in at the end of day right here. We do have this gap, I guess you could call it, trades coming in at the lows. It was very mixed on the Qs intraday. Now let's have a look at the Russell 2000. Now this is the last 7 days. We saw a late print come in right here. This trade probably took place here. Russell went lower. It was probably a short. We did see some big trades come in here as well, potentially a closure of this. But if we break it down, intraday we saw a couple of trades, medium-sized trades come in here. Price did go lower, probably shorts. Then we saw, by the way, this is the 20 largest trades. All of them took place right here. Huge amounts of trades come in here, and these were likely buys. How do we know? Well, price went up and price stayed above this level into end of day. Thank you so much, guys. Please like this video, subscribe, leave a comment. If you want more of these, let me know. Catch you later.